for the financial manager's analysis, which is stated earlier. One of the chief objective of the statement is to identify the sources generating the funds and specific where they get utilized during a specific period. So that means ultimately they need to identify the generation and the sources of funds and how the funds has been utilized for the different objectives. That the significance of the statement can be understood when it has been for the various utilities of the fund flow statements. Let's see the significance and utilities of the fund flow statement. Start with the first point, that is analytical tool. This is an analytical tool of a financial analysis which explains the changes of working capital and its effect on the liquidity situation. So ultimately this flow of funds is showing the changes of your liquidity in the business during the specific accounting period. It indicates what object of new fund was obtained and for what purposes was utilized. That means when you borrow the funds in the business, what was the objective, and when it is utilized, whether it is utilized for the same object where the fund has been borrowed in the business. Next is design policies. This statement helps the management for preparing a budget and financial planning for the coming period. The manager can estimate regarding the required fund of purchasing of fixed assets, investments and working capital, as well as the payment for a different concern for like a dividend, purchases of an assets and the repayment of any long-term funds with the help of this particular statement. So from this report and statements, they identified the amount of the funds has comes into the business and out of the business. Next point is, it is a control device. That means the statement is actually helpful to controlling in the certain period of time. How it would be affected? This is a comparative analytical statement where the balance sheet and profit and loss account of 2 consecutive years are going to compare. The statement compared with the budget concerned will show to what extent the resources of the firm were used. So up to what extent whatever the resources you borrowed in the fund, it is used according to the plan. So whatever the plan you already planned earlier, and whatever the things and transactions occurred during the year, that transactions will be compared with your plan, and to what extent the utilization was unplanned. So if there is some transactions occurred according to the unplanned, would be identified and checked due to the comparison of fund flow statement. It is worked as a control device and the manager can take immediate steps if it is required. So if it is required, then any steps for improvisation, for changes, and if there would be a sum out of the track, then it would be identified. Moving to the next significance, that is reflect financial position. It helps to know whether the financial positions of the company is sound or weak, or it is not perfect. It reveals meaningful information as regards the liquidity positions of the business and its repaying capacity. That means the company's liquidity positions, if it is weak, then how it can be improved and how you can take decisions for requirement to upward and to find out the some decisions for changing your current financial position. Next is uses of working capital. This is ultimately the fund flow statement is basically concerned with the changes of working capital. So how it would be affected to the uses of working capital? This is actually find out the causes for changes in the working capital. It's attempted here to bring to the notice the management any tendency that depletes the working capital in providing resources that are required for various aspects and various purposes. So wherever the working capital has been deployed for the different tasks, that would be identified through this particular statements and reports. Next is helps to lenders. There are many lenders like bankers, financial institutions, creditors, and many more. This statement and report would be helpful to this in assessing the degree of risk involved in the business for granting further and new funds for the development. So with these comparisons, the third party or the people who are lending their funds in the business, they get an idea whether we have to further funds and deployed further amount in the company or not. So this statements and reports would be helpful to them also. Next is direction for business. So this particular statement and reports is giving the directions and the path to the business and their business concerns. This statement may be conveying the message to the management that various problems raised in the near future because of the shortage of funds. If there is any shortage, then they would be identified, they would be marking to the management, and they click the bell to the management, there is some shortage of funds, and because of that maybe you are going to face the problems in the near future. But suppose if they have enough fund, or maybe they have an excess fund which also affects positively or negatively, would be giving a direction to the business. So ultimately it shows a management to plan for right actions for more effectively, so that to avoid the future problems. So future problems can be avoided from this. Now moving to the next point, that is limitations of fund flow statements. There are few limitations because of ultimately it's an analytical tool. So analytical tool have a big limitation that the sources of informations are perfect. If it is not perfect, then whatever the analysis has been done may be biased. The flow of funds bases on certain informations, and that informations create limitations. First, it ignores non-fund items. That means if it is not a fund related item, and if it is not affected to the fund, it is never recorded in the statement and report. So it becomes a simple tool compared to income statements and balance sheet. It is prepared on the basis of information which is in historical in nature. That means only historical data has been compared for the calculation of flow of funds. It ignores to project a future operations. They are never calculated and never assumed that for the future operation. It also ignores those transactions that are considered in current accounts or non-current accounts. That means if the transaction occurred only in current accounts and only in non-current accounts, cannot be affected to the flow of funds. This is not an ideal tool for financial analysis because of these limitations, because of it ignores the non-funds, it ignores the only transactions occurred in the current accounts or maybe in the non-current accounts. They say this is not a perfect and ideal tool. But if the company willing to know the exact movement of their flow of funds, I think so this is a very much affected reports and statement. It does not provide any additional information to the management because financial statements simply rearranged and reconstituted for the analysis of flow of funds. So this is a limitations of fund flow statements for the requirement of the fund flow statement. Now, a very important part of the flow of fund statements or fund flow statements that we need to identify the changes and effects of flow of funds on working capital. That means we need to identify the changes of working capital. As I already mentioned earlier, that's whatever the changes occurred in the working capital statement that would be affected to the flow of funds. The fund flow statements depicts the changes in working capital. It is more suitable to prepare the schedule of changes in working capital before preparing a fund flow statement. So before preparing the fund flow statements, we need to prepare first the changes of working capital, and whatever the changes are occurred in the statements would be reflected in the fund flow statement. The statement of working capital is prepared with the consideration of the current assets and current liabilities. So here in these statements, we recorded only current assets and current liabilities. It helps measure the movement of changes in working capital during a stipulated time or during a particular period. As I already mentioned, we are going to compare 2 years consecutive balance sheets. So 2 consecutive years balance sheets are going to compare, identify the differences. So the particular period, it means 2 consecutive years, and that changes we find out during the year. The term working capital refers to the excess of current assets than the current liabilities. Here the working capital formula is working capital is equal to current assets minus current liabilities. So any changes between these two, it's considered a working capital. This statement shows either the increase in working capital or a decrease in working capital by comparing the 2 years data of a working capital. The final results of a net decrease in working capital. In case of net decrease in working capital, it is a sources of funds. It is a sources of funds, and in case of the net increase in working capital, it's an application of fund, as I already mentioned in the earlier part of the pro forma of a fund flow statements. So any changes in the net decrease in working capital and the increase in working capital would be affected to the fund flow statement. Some rules are there for actually preparing a working capital statements, but before rules, I'll show you the pro forma of a working capital statements and I explain the rules and regulations of that working changes of working capital in the different way. See, this is your pro forma of a working capital statement. As I already mentioned earlier, that in the part of changes of working capital, it's a differences of current assets and current liability, and this is the information of particulars last year and the current year. Here it is increasing in working capital, and this is a decreasing in working capital. That means the changes of working capital, changes in working capital. The comparison of this is current assets. Under the heading current assets, debtors, cash and bank balance, stock, any outstanding incomes, debtors, cash and bank, stock, any outstanding incomes. These are the current assets of our bills receivable. The current assets are recorded in this way. This is total current assets A. Then current liabilities, under the heading of current liabilities, creditors, bills payable, bank overdraft, provision for taxation, any outstanding expenses and etc. are going to record for both the years. That is total current liability. Then find out the net working capital, that is difference between A and B. So A is the total current assets and B is the total current liabilities. Whatever the changes are occurred, that is your net working capital. And from the comparison of the net working capital, we will find out whether increase or a decrease in working capital, and that would be reflected here. Now, what are the rules to be applied for the same? Take it one by one. Increase in current year current assets than the previous year, it's always considered an increase of the working capital. Take an example. Suppose the last year debtors is rupees 5,000 and the current year debtors is rupees 7,000. If the current year current assets is higher than the last year, the difference between these two, it's considered as an increase in working capital. It's a first formula. Current year current assets is higher than the last year, it shows an increase in working capital. Reverse case, in case of the last year current asset is 7,000 and current year current assets is rupees 5,000, that means the current year current assets is lower than the last year, it always shows a decrease in working capital. How I will explain you. This is the second formula. In case of the current year current assets is lower than the last year, then it shows a decrease in working capital. Now affected for the current liabilities. In case of the current liabilities, 3,000 rupees in the last year and the 6,000 rupees in the current year. So it means the current year current liability is higher than the last year. It always shows the 3,000. Difference amount will be showing as a decrease in working capital. It means if you are going to compare this, the current year current assets is higher than the last year, it's increase. But current year current liability is higher than the last year, it's decrease in working capital. And the reverse formula is, in case of the current year current liability is lower than the last year, it always shows increase in working capital. How? Let's see. Suppose opening cash balance is rupees 5,000. Opening cash balance is rupees 5,000. Now see here, the how much debtors you have? Debtors is rupees 7,000. The current year debtors is rupees 7,000. Correct? And the last year debtors is rupees 5,000. So the current year debtors, it's reflect in the case of different way. Opening cash is 5,000. How much debtors opening you have? Opening debtors is 5,000 would be added into this. So the total amount of, that means we assume that the opening debtors amount is received during the year. That's why it's added here. So opening cash balance is 5,000 and debtors amount received during the year, which was opening, added into that. The total amount of cash is 10,000 during the year, and the current year debtors, that is closing debtors, is rupees 7,000, reduces your cash balance. Because of this amount would be received maybe in the coming period of time. So that reduces your working capital, and that's why your opening cash balance is 5,000 but your closing cash balance is rupees 3,000. It shows increase in working capital, and that's why the increase in working capital is always recorded in application of fund. This is your application of fund. So application of funds because of the changes of the cash. If you want to see the another example here, suppose the example is related to stock. Opening cash balance is 5,000 rupees. Correct? Your opening stock valuation, that means opening stock, we assume that the opening stock has been sold out during the year. So opening stock value added into that sold out, the cash received. So your cash balance during the year is rupees 12,000. That we assume the opening stock has been sold out during the year. And this is a closing stock which was not sold out yet, so which may be affected to your working capital, and minus from it. So your closing cash balance is rupees 7,000. What was your opening cash balance? 5,000. What is the change after this transaction? Your closing balance is rupees 7,000. That means your closing balance is increased 2,000 rupees. That increases, it's affected a decrease in working capital. And decrease in working capital, that is why it's a sources of your working capital. This is all about the changes of working capital. Now, moving to the next point, that is adjustments effects on a profit and loss accounts. Before we are going to discuss the pro forma of adjusted profit and loss account, I want to tell you some adjustments entries regarding to change of profit and loss account. Because of their changes may be affected to the fund flow statements. How? Let's see. The profit is a very important tool for the fund flow of the business. So that means how the fund flow is affected, that would be sometimes identified through the profitability of the company. The operating profit revealed by the profit and loss accounts represents the excess amount of sales revenue over the cost of goods. That means whatever the amount of profit you realize, that is realized because of the formula is the sales revenue is higher than the cost of goods sold. This fund is generated only through the internal sources of the business. Because of this is actually happened through the part of profit and loss accounts. However, it is very much important to note that the net profit as shown by the profit and loss account does not always affect and represent that the amount of fund changes from the business operations. So it does not mean that whatever the profit is received and whatever the profit is arrived from the profit and loss account, this is only because of the changes of fund flow. So the arguments behind that are certain items which appear in the profit and loss account but do not involve any payment in cash. It means these are the non-cash items. It affects to the profit and loss account because of it's a part of an expenditure, but it is not affected to the cash. So we have to identify certain items. For instance, that is depreciation, provisions, writing of preliminary expenses, intangible assets, etc. Such items do not reflect on the working capital and are called non-fund or non-cash items. Hence, fund from operation is prepared to find out exact inflow or outflow of funds from the regular operations on the basis of that which have been readjusted to the different profit and loss account. So in the basis of that, we need to identify that such type of transactions and reverse back to the profit and loss account and find out the adjusted profit or loss account. For that, we need to prepare adjusted profit and loss account and observe such type of transactions one by one. Let's take this first transaction, that is depreciation. As we already discussed, which are the transactions would be not affected to the cash or non-cash items. The first is depreciation. It is the decrease in the value of fixed asset. That's absolutely right, because of the depreciation has been charged on fixed assets. So it's always decrease. When you charge a depreciation on fixed assets, the fixed assets has been decreased, but it's not affected to the fund because of its non-cash items. The depreciation is never paid to the owner of the fund, so that's why it's a non-cash item. It affects neither the current asset